Up next, we have a panel, and the panel discussion is Managing Multidimensional Risks. And as moderator of this panel, I'd like to invite Jim Micklethwaite, Managing Director, Head of Financial Markets, Thomas Murray, United Kingdom. Morning. So your seat is allocated for you? Yes, I will. Now, we have speakers for the panel, of course. First up, we have Ms. Setenay Yağanoğlu, PhD, Director of Data Services, Merkezi Kayıt Kuruluşu. Morning. Next up, we have Mr. Ömer Gazimihal, Deputy General Manager, Enterprise Product Management, Turkcell Digital Business Services. Hello. Our next speaker is Marcus van Abbé, R3, Head of Digital Market Infrastructures, UK. Morning. And our next speaker, last but not least, is Bulat Nizamov. He's a product expert, CMA Small Systems Abbé Solution from Sweden. Now I'll pass it on to our moderator. Enjoy this panel discussion.
Thank you very much. So good morning, everybody. Esteemed guests, ladies and gentlemen. So I'm Jim Micklethwaite from Thomas Murray. I've got the pleasure of moderating the first panel of the day, which will focus on multidimensional risks. First of all, I'd like to thank MKK for huge effort they put into organising this unique event, which is wonderful, and also to AECSD and AMEDA for inviting us here. It's a pleasure to be back in Istanbul again. So what are we referring to when we're talking about multidimensional risks? So it's nothing to do with the kind of Marvel movies or theoretical physics, so nothing to do with mathematical dimensions. What we're talking about is really kind of evolution of traditional enterprise risk management approaches to try and actually account for more complex and interconnected risks. So I was in the last AMEDA meeting in Doha in May, and I talked a little bit there about some of the macro level types of events that traditional enterprise risk management frameworks don't necessarily account for. And I think we'd like to push on from that in this panel and talk about those kinds of events, but also discuss how the traditional approaches to enterprise risk management need to evolve to account for not only those types of macro high-level events, but also understand how they might be connected to other risks, and how the frameworks need to be able to adopt a more sophisticated approach to accounting for these risks. So traditional enterprise risk management, as we've seen in CSDs and banks, has got some limitations. So it tends to be very focused on sort of the individual risks and treating those individual risks. And that kind of promotes very kind of siloed thinking. So you identify your operational risks, which are identified by the business, and the business deals with them. You'd identify your IT risks, and IT will deal with them, and so on and so on and so on. But how are these different elements kind of connecting together, and how are those different groups within the organization actually talking to each other and establishing sort of programs to be able to deal with the knock-on effects of one risk to another? And I think it's very important that we are able to look forward as well as backwards. So with traditional enterprise risk management, you understand your kind of previous events and your previous losses, and everything tends to be in the rear view mirror kind of looking back. But with new technologies and sort of more complex regulatory frameworks and more complex financial markets, new asset classes coming in like crypto, we need to start thinking in a more kind of forward-looking manner and see if we can develop the ERM kind of philosophy around that, okay? So some of the things we want to focus on in the panel today that are definitely threats to CSDs. And number one, cybersecurity. It's something that I've been banging on about for a while now, and it's certainly the biggest risk that we at Thomas Murray are concerned about in terms of financial markets. And I was in a market a couple of weeks ago, and I asked the regulator, what's the one thing that keeps you awake at night? And they instantly said cybersecurity. So it's a big issue. Aligned with that, we've obviously also got operational resilience. And I've also referenced previously that there are regulatory sort of headwinds coming through from various parts of the world. In Europe, we've got new regulation around operational resiliency, and certainly the Americans, Hong Kong, Singapore, Australia, and several other countries are bringing in regulation around operational resiliency, cyber resiliency, which is tied into that. We have increased and more complex regulatory environments, and certainly the burden on CSDs in other parts of the world, particularly in Europe, are very significant in terms of compliance and regulatory risk. And then we've still got the kind of traditional risks that we're all used to in terms of systemic issues that are arising from market volatility, so liquidity risk, market risk, and kind of systemic risks that follow on from that. And obviously, with the kind of rise of crypto and digital assets as a new component to that, that's also going to put more pressure on controlling those systemic risk elements. So to explore these questions today, we've got a very diverse panel. So we don't have, apart from one, any CSDs on the panel. So Setenay is the one CSD practitioner here. So Setenay Yağanoğlu, apologize for pronunciations, Director of Data Services at MKK. Setenay has more than 15 years of experience in capital markets. She's responsible for derivatives reporting, fixed income reporting, the investor risk monitoring system, the data analysis platform, and the real estate-based and developing financial instruments information system. Sounds like you've got a huge amount of work to do. Ömer Gazimihal, Deputy General Manager of Enterprise Product Management for Turkcell Digital Business Services. So Ömer is a trained computer engineer and telecommunications expert, was previously at Cisco Systems for 9 years, joined Turkcell in 2018, and Ömer is responsible for Turkcell's fixed data connectivity, unified communications, cybersecurity, and vertical industry solutions. So providing a lot of the telecommunications infrastructure in Turkey that is being utilized by financial markets. Okay. At the end, we have Bulat Nizamov, who's product expert for CMA Small Systems. CMA is a Swedish-based provider of system solutions to financial market companies, especially central banks, clearinghouses, exchanges, and CSDs. Bulat is a solution and product expert with over 20 years of experience in financial systems integration, software development, and product management. He's led transformative projects for central banks, exchanges, and CSDs worldwide, and has played a key role in developing and implementing CMA's trade and post-trade solutions, which are used in over 15 countries. And finally, Marcus van Abbé, who's head of digital market infrastructures at R3. Marcus is a dedicated professional in the field of FMIs with over 13 years of experience. Now, R3, founded in 2014, is a leader in developing digital solutions for businesses worldwide in tokenization and financial market operations, primarily through their DLT Corda. Marcus is the head of digital market infrastructures at R3 where he continues to contribute to innovation and transformation in the financial sector, working towards the future of digital securities and the broader financial ecosystem. So that's the panel that we have this morning. So what we're going to try and do is dedicate about 10 or 12 minutes to each panelist, and we're going to have a mixture of presentations and discussions. We will try and leave some time at the end for questions from the audience, and we've got some microphones for that. So as we're going along, if you do have any, if you think of anything you want to ask at the end, then please feel free to join in, and we'll try and make it as dynamic as possible towards the end of the panel. Okay, and we'll try and keep to time as well. Okay, so to lead us off, Setenay, would you like to take the floor and discuss how MKK is monitoring and measuring the systemic risks in the Turkish market?
For the introduction, Jim. Good morning and welcome, dear distinguished guests again. I'm here to discuss the risk management dimension regarding the central security depositories. My passion in this topic stems from how it inflicts uncertainty and how it gives powers while decision-making processes. As you identify, assess, mitigate, measure, and monitor risks, you can facilitate informed decision-making and overcome uncertainties. I'm delighted to explore the different aspects of risk dimension here with my fellow panelists. Throughout the discussion, I hope to delve into the key elements of systemic risk assessment and management from a CSD point of view, as Jim mentioned. I hope and think you will find this topic interesting because systemic risk affects the overall market, not just a particular industry or a stock. And I'm eager to hear diverse perspectives of risk management, both from my fellow panelists and the audience. So we can start with MKK's response solutions to systemic risk. MKK offers solutions for the measurement of systemic risk mainly on two dimensions. One is improving the structural dimension by sharing data to regulatory bodies, and the second is contribution to transparency through financial literacy. As you know, the need for the definition of systemic risk has risen after the global crisis 2009. There were many definitions, but the one I chose to talk about is the IMF definition, which has three main features: its substantial portion impact, the spillover effect, and its association with highly adverse macroeconomic effects in the absence of rapid and strong policy responses. The way to address and overcome these symptoms was found in the construction of trade repositories. Trade repositories play a crucial role in financial markets by collecting and maintaining records of derivative trades. This process aids regulators in monitoring system risk buildup and ensuring financial stability. Recognizing this critical function, Capital Markets Board of Turkey authorized MKK as the trade repository of Turkey. Our trade repository system is instrumental in recording transaction details of the OTC and on-exchange derivatives from both non-financial and financial counterparties. The system was constituted and aligned with standards set by European Securities and Market Authority and European Market Infrastructure Regulation. As of today, there are 235 members who are actively reporting to the system daily and generating 3,100 notifications on average, 300,000 notifications on average each day. Since 2020, MKK has notably enhanced the data and trade repository services. These enhancements include T0 reporting, fixed income reporting, investor risk monitoring system. All these services function for the improvement of structural dimension of systemic risk. Together with these systems, we provide data to regulatory bodies like Capital Markets Board, the Central Bank, on our securities, which are held under Central Securities Depository, on derivatives, fixed income, and other data that we have. We use BI tools for reporting services and provide more than 1,000 reports each day to more than 200 different groups of receivers on data stemming from electronic warehouse receipts to the securities, from PDB data to e-general meeting data. Our data services, which enable the transformation of generated data into meaningful outputs, include data analysis platform, intermediary institutions data analysis platform, the real estate based on developing financial instruments information system, and risk tendency index, which has been developed by ourselves. All of the products are our in-house products. These developments have significantly bolstered our capability in managing and mitigating systematic risk in Turkish capital markets, along with ensuring information transparency and improving financial literacy. We believe once the regulatory bodies have accessed the necessary data and the systems to track the whole market, the systemic risk is easier to define and to prevent from. Similarly, once the parties who make up of the data, like the people, the individual investors, or the individuals who manage risks and manage investments in the institutions, are aware of the consequences of their actions in their financial decision-making processes, the happening of systemic risk is less likely, and this can only happen with improving financial literacy. This is my answer to the first question.
So, I mean, just on this then, in terms of the data-driven approach, I mean, as I was mentioning at the beginning, I think that if we're to develop more kind of sophisticated and more dynamic sort of risk management systems, data is absolutely critical. So maybe you could expand a bit more on how you're utilizing data to kind of automate and more dynamically monitor the risks on a continuous basis.
Okay, thank you. I will answer the question firstly, referring to one of the philosophers from this continent, Rumi, who said, "Do not be satisfied with the stories that came before you, unfold your own myth," he says. And this was the spirit that we had with data and trade repository services. We did not just stay with as trade repository functions, but as you mentioned, with the data-driven approach of risk assessment, we started to produce new products to share data with both regulatory bodies and our members and public. So with user-friendly applications, we enable parties report their transactions easily in formats that enable for us to measure, analyze, and provide meaningful outputs from the data. With our timely and accurate financial reporting to the regulatory bodies, evaluations can be made possible because we provide a dynamic review of data access and management, proactive data sharing, and integration system. Examinations are made possible on various data patterns like investors, financial counterparties, non-financial counterparties, and transactions and portfolio levels. So with our derivative and fixed income reporting, investor risk monitoring system data, and with the securities data we provide, excessive credit growth, leverage, maturity mismatch, market illiquidity, contagion, and network measurements of systemic risk can be realized and used in risk mitigation processes. Similarly, direct and indirect exposure concentrations can be found and made realizable. These all, in the end, serve for improved market stability and efficiency by strengthening the resilience of financial infrastructures. We are able to reach to these outcomes due to our data collection standards, methods, and the strong IT infrastructure built behind. Currently, we hold $515 billion worth securities within our depository system. As our CEO and board member, Dr. Ekrem Erkan, mentioned in his opening speech, we hold nearly 36 million registered investor accounts, with nearly 11 million of them with balance. 569 Borsa Istanbul equity market companies have a market cap worth of $356 billion. We do not only have the data of the conventional investment instruments, but, for example, data of 17 commodity types registered in 222 licensed warehouses within agricultural commodities market with more than 4,000 investors have a capacity of 12 million tons. One of the newest investment systems popular worldwide is crowdfunding system. Within this system, we track of 137 registered companies with more than 40,000 investors. With our intermediary institutions data analysis platform, which is a BI tool, we provide members their portfolio and investor data with different breakdowns, like the geographical location of their investors, the portfolio levels, the investor type of their investors, the age group of their investors. This enables strategic decision-making processes by rendering peer group analysis, so they can compare their data with the other members. With data analysis platform, Information transparency and ensured higher investor confidence is provided by providing information on portfolio values like Borsa Istanbul indices, on nationality, statistics on foreign ownership per instrument type, investor statistics based on age, gender, and geographical location. Because of the structure built behind, the strong structure we built behind, we can track, for example, how investment fund investors have gradually risen from 2.9 million to 5.3 million in the last years, and how our equity investors has reached up to 7 million investors. Due to this infrastructure behind, we can track the trend of general assemblies, the number of companies with women chairmen of board of directors, for example. Within the data analysis platform, one of the important information we share with public is the investor risk tendency. This supplies information decision-making by presenting an index. This is an in-house product as well, like the rest of it. With the risk tendency index, we can track the investor's risk appetite with their weekly, monthly, and yearly changes. We can analyze how different investor types attitudes towards risk. It's such an elastic algorithm. Based on such an elastic algorithm, we can even calculate the risk tendency index of the people here in the room if we have the necessary input. With real estate-based and developing financial information system, we provide and supply increased choice of investment alternatives and higher diversification of investor portfolios in capital markets by facilitating access to product, issuer, and performance information on lease certificates, real estate company shares, and real estate investment funds, which are traded in Borsa Istanbul. We show the data related to them as closing price, transaction volume, and return, and the public can compare these data as well. We also provide international cooperation by providing country links from the Standing Committee for Economic and Commercial Cooperation of the Organization of the Islamic Cooperation. We give 14 countries links so far. Last but not the least, we are working on the Capital Markets Risk Project, which will enable first the regulatory bodies to log in and collect their data from a central application with the different and updated formats possible. Before closing my talk, I would like to give one last quotation to Malcolm Forbes, who says diversity is the art of thinking independently together. And I think so far we have been doing this all together in this conference room through this organization. So I want to say thank you for listening to me, and we're happy to see you all here. And hopefully with your presence and contributions, our organization has been an occasion for good opportunities and collaboration so far. Thank you.
Good, thank you, Setenay. It's remarkable actually to see how advanced MKK is in terms of developing its different quite diverse data platforms. So it's not just the trade repository side. It's also looking at all of these kinds of ancillary areas where you're able to provide very kind of sort of granular data, even down to a retail level. So I think that's really very advanced, actually. So let's move to you, Ömer, and let's talk about some of these kind of more physical issues. Obviously, in Turkey, we have, as you were explaining to me earlier, 3 fault lines which join around Istanbul, not to worry anybody too much, but earthquakes are a really big threat here. And in terms of in terms of operational resilience, also cybersecurity is a big issue. So how can CSDs better protect themselves from cybersecurity? How can they better protect themselves from some of the more physical risks as well? Maybe you would like to tell us a bit more about that.
Well, thank you, Jim. And first of all, thank you for inviting me for this splendid event. I'm out of the sector. I'm in the IT sector. I've been working over 25 years now. Well, the first thing is that the way we perceive the stock exchanges and the finance sector in general is a very primitive picture, which is we have the data which needs to be preserved in terms of integrity. And also we have to, as the IT people, we need to establish secure communications around it so that you have secure transactions. That's the way we look at it. And as you mentioned, there are several risks around that in Turkey in particular. Unfortunately, Turkey is in a very difficult geography, and we are running on different fault lines in terms of earthquakes, and that's a major risk to be considered in every industry actually. And the data, I mentioned the data. Data is stored in storages, and those storages are located in data centers. And usually, data centers in the finance industry regulated by, mandated by regulations that you have the typical approach that you have a primary data center, and then in a different geography, you should have a disaster recovery center. This is the legacy infrastructure that's been running over a decade or 2 decades now. However, that's where the black swan lies in. What happened in last year's heartbreaking earthquake in the east of Turkey, not in the finance industry, but another very well regulated industry, in the energy. The energy company of the region, energy company of Maraş, which was in the epicenter of the earthquake, had this primary data center in Maraş. And their disaster recovery center was located around 200 kilometers away, which deemed very reasonable location in terms of geographical diversification. Because usually the earthquakes impact the city they strike, and earthquakes wasn't that type of an issue around that area, was not expected so often. What happened is last year's devastating earthquake was it covered an area similar to the size of Denmark. It impacted a dozen cities in Turkey, and unfortunately, the energy company of Maraş lost its both primary and disaster recovery data centers. As Turkcell, you may know Turkcell as a GSM carrier of Turkey. However, we are also the biggest IT infrastructure company in Turkey, and we've been investing data centers and cloud infrastructures over a decade now. And our newest data centers are all earthquake resilient data centers. And there's a simple technology, what we call there are bumpers, I would say, underneath the buildings that are taking the shock of the earthquake, so that they dampen the shock of the earthquake, so that the buildings are integral. But that's not only the construction, but the communications and everything else is redundant, so that they can survive on their own. And we've been constructing these data centers in all of the geographies of Turkey, and enabling all the financial institutions to have a much better infrastructure in terms of geographic redundancy. So, but that's not the only picture. We also allow cloud services to finance industry, and we name this as sovereign cloud. It's an industry name because the financial data is so sensitive that you cannot collocate the financial data in general public cloud. You need to isolate it in industry clouds. And we have up to 2 years ago, we had private cloud, the government cloud, but we also launched the finance cloud for financial institutions. the finance clouds allows the financial institutions to have a better redundancy, better scalability, and a lot of features, and it's dedicated to only financial institutions. And there's two governing bodies here. Turkish regulator BDDK is governing the big banks and also finance companies, and the Central Bank of Turkey is governing the payment companies. Two governing bodies are governing. So we actually have two finance clouds, one for the big banks and the other one for the payment systems. And these allow the companies to easily scale up or scale down in terms of when they needed resources, in terms of servers and storage and all the IT equipment you could imagine, and so that they can easily expand and decrease their IT infrastructure. Going back to the story, the energy company in Maraş, what happened afterwards was some brave folks entered the building, a half-collapsed building, risking their lives. And they entered the data center room, and I've seen the pictures. The racks were all over the place, the servers were all over the place, and they painstakingly took out each and every server out of there, and they were able to they carried them to a container nearby, and from that container they transferred the data back to our data center in Ankara. And so we used the cloud, we scaled it up and used the cloud to gather the data again and bring the electricity company up so that we could provide electricity to more than 5 cities. And so that was the actually resilience of cloud and convenience of cloud. So we had the capacity conveniently bring the company up. And another issue, as you mentioned, is the cybersecurity. And cybersecurity with AI is very peculiar. AI is supposed to decrease the workforce in every industry, right? In cybersecurity, it requires more manpower. And what's happening is to understand the risks of AI, is again, you need more expertise and vertical expertise. That's what we are trying to bring in. We have over 150 cybersecurity experts, and each of these experts are vertically aligned in different areas of cybersecurity. It's just like medicine. You have different doctors, and same way it goes for the cybersecurity. Same expertise, deep expertise is required in this area. And also, another important thing is going back to the infrastructure risks, cybersecurity. What you have is a cloudification of cybersecurity. When we talked about cybersecurity, it was a lot of appliances called firewalls and load balancers and other servers from a very fragmented number of vendors. And so what we are trying to do is to make them as a software as a service, and position them in the cloud, so that when you have two risks, which are both could happen: earthquake or a cybersecurity attack, and in one of your facilities, if it's knocked out, you can easily, conveniently move on from other locations as well. So you can see in this example both risks mitigated in one solution, which is the cloud itself and finance cloud, and which is solving both problems actually.
Good, thank you, Ömer. And I definitely agree. I think, again, I mentioned this in Doha in the last meeting, that we're starting to see much more of an acceptance of cloud for holding sensitive financial data, where if you go back a few years ago, it was very much not on the table at all, and certainly attitudes start to change in the last 5 years around this. So I think we'll see more and more sort of cloud adoption in the CSDs. So moving on to you, Bulat. I think you just wanted to start off with telling us a little bit more about CMA, and then we have a couple of questions for you.
Very much. Yeah, good morning, everybody. It's of course it's an honor to be here and introduce our products and solutions for risk management as well, since the topic here is about central security depositories. So in our interconnected financial ecosystem, effective risk management is critical for all of our main clients, which are central banks, CSDs, exchange clearinghouses, and payment system operators, and also commercial banks. We are CMA, Swedish company with over 30 years in financial technology development. So we are very focused, having completed over 500 projects across 24 time zones, from Latin America to Asia. We probably serve about 55 central banks and exchanges. Just for example, since we're dealing with a lot of payment infrastructure and we're dealing with risk, we're also dealing with innovations. And one of the examples, very good example in Brunei, it was the first Asian CSD which adopted ISO 20022 Swift MX messages standards 8 years ago. And we're talking about that doing now, we already did it 8 years ago. So what is, back to the topic, what is the risks? Basically, risk is a chance of losses. So in capital markets, that effective risk management ensures stability. So in terms of post-trading, it's about stability. So how CMA products for financial ecosystem can help in this regard? Next slide, please. At the heart of our offering, there is, at the heart of our offering is a CMA product suite, which includes core systems for trading, clearing, settlement, collateral management, risk management, payment systems, and as long with in line its value-added services or value-added models. Regards of this conference, we have the DepoX platform, and it's not just a product, it's a complete platform. It means that a solution that can automate you from the trading to front and middle and back office operations. And also since in the middle office, it's effectively managed these risks. So let's name it, these risks, what they are, and practical examples, since we are practitioners. So market risk, we covered it by valuation model. We do real-time valuation as testing tools that helps mitigates market fluctuations. We deal with liquidity risk by real-time STP-based settlement with autonomous payment systems, which prevents bottlenecks. And also, while collateral management might ensure additional liquidity during the day or over the day. Credit risk, managed by collateral management model, credit assessment tools, validate participant tools, validate portfolios, and make automated margin calls when necessary to secure exposures. Operational risk, it's automated by STP, reducing errors and enhance efficiency, supported by strict standard secured message protocols. FX risk, multi-currency support. We need to real-time monitoring about the exposure that we have in FX and manage it effectively using FX tools. Custody risk, covered by accounting model. So it should be very accurate accounting with the historical record to have and segregate assets to minimize any custody risk. Legal risk. It's about compliance monitoring and audit trails that ensures that that the system follows the regulations. Fraud risk. It's covered by our risk management model. It's fraud detection and access controls, reduce authorized transaction risks. And of course, we have, since we are providing the whole ecosystem, we have a payment system, which is done by RTGS. It basically installed at the central bank, but also we have examples of installing payment system to payment providers. So RTGS, it's addressed liquidity risk through intermediate settlement, while clearing system, which can be built on the PERCS platform, also reduce operational and liquidity risks. And it's important to mention about value-added services, as could be separated model, separated system, as fraud detection. It monitors transactions, safeguard against fraud, KYC and AML screening, ensures compliance with anti-money laundering kind of things. End-to-end tracking, so it provides visibility into transaction lifecycle, and which is also already mentioned, that data-driven. So for data-driven, we have statistical and reporting model, which we call Data Mart, and it offers actionable insights driven by AI and machine learning algorithms for better risk management. So to summarize that, our CMA suite is integrated financial ecosystem that empowers our clients, its central banks, exchanges, depositories, clearinghouses, commercial banks as well, to effectively manage different types of risks. By combining all this core system in product suite, it's with the value-added services, we equip our clients with the tools to operate securely, efficiently, and in today's very fast-moving markets. So what is important to say that we remain committed to innovative solutions by our smart people, customizing it effectively for such smart and valuable people as you are here and our valuable clients. And it helps our clients navigate the complexities of the global financial environment and bring stability. And the statement, of course, keep me moving forward, innovate now, build a stable tomorrow. So, yep, thank you for that explanation about the CMA product suite.
Thank you, Bulat. And it's interesting that you're talking about the different systems and the different risks that your modules are able to monitor, and I think you mentioned as well about the way that you can actually connect, the data from those different elements to get a more kind of holistic view of the kind of entire risk picture. And one of the things I talked previously about in Doha was sort of new systems and putting in new big core systems and the project risks that were associated with that. And I gave some rather scary numbers to people about how much people had lost in various disasters over the years doing this. But there's also a risk with kind of maintaining your legacy systems as well. And maybe you could kind of elaborate more about that in terms of how that kind of limits organizations' ability to keep pace with innovation, and there's probably a regulatory and compliance dimension to it as well.
All right, yep, thank you. You see that, first of all, we, of course, it's a question that the space is limited in terms of people who's managing this solution. So it's important to say that we need a space where the community can discuss these questions and openly, freely, and having this collaboration. So yes, as well, having this ability, I'm inviting you to do this, to participate in these communities and discuss that kind of cases. Related to the question itself, with the legacy system, how we deal with that, there are a few examples. One of it, how CSD is doing by what we see by the practice. There's it's maintained by disaster recovery systems. So even you have a legacy system, you need a disaster recovery system, but not as a copy as the same system. CSD is maintained secondary system from another vendor. There's a space to work collaboratively with other vendors, and there is space to collaboration with CSDs. So backup system provided by separate vendor, different location. It's important to have a real-time data replication. So it's achieved by the new technologies. It's achieved by in-memory processing in terms of if we go deep to technologies. With real data streams and driven by microservices. So, and we had such example in Singapore. Part of it we implemented. Another big risk with the legacy system that that vendor is no longer exist. And the people who is doing that in-house, developers or brains, that they already left, and there's no well documented systems. So it's makes hard to grow, difficult to follow the regulation or fix any problems. So in this regards, how CSDs maintain this? It's important to move to the new system with so-called open APIs, which allows you to keep the core system and on top of this, build fast and react fast to any changes. So the new system could be able to collaborate with the local fintech company or the local IT team. So it's very important that not just growing the local in-house, but it's important to collaborate with vendors. And stress testing as well. So even you have a legacy system or moving to a new one, it's that you need a running test that simulate busy times, trading settlement busy times. And we see that a lot of CSDs doing or requesting that to do that. So, but it's important to have the proactive approach to that volumes that you're thinking to in your roadmap and do stress testing before you chase them. So one of the cases, of course, you can ask your vendor about having a separate solution for that. And what I would also important note that it's important to think about innovations. So, but it was mentioned about data-driven approach to move automated settlement system as well. So speed is the key. Trading volumes are growing. System needs the real time, and it looks like even we talk about the post-trading, but the post-trading system should work as trading system in the real time. That's important. So it should process instantly. And I do remember then I started my career like 20 years ago in investment bank. It was a story that actually from the sell side. It was a story that they were complaining about one market. It was T+7 settlement. Yeah, there was a lot of jokes about it. One of it because why it's T+7? Yeah, because it's give us times for a whole week to decide if they really want to buy the dip. Yeah. By moving to financial infrastructure sector, we helped our clients to move from that T+7 to T+3 and T+2, and even I think the trend is T+1, which are ready. So this is the way how we can deal with the legacy. It's innovate and statement. Yeah, again, keep moving forward. Innovate now, and you will have a stable future.
Thank you, Bulat. Marcus, so you've very bravely opted not to have any slides. So we're just going to talk, yeah? We've been talking about digital assets, blockchain for a long, long time. And actually, finally, I think something tangible is really happening. And certainly R3 seems to be at the forefront of you know, really getting something moving, particularly in the central bank digital currency space. And a number of CSDs probably in this room are preparing for tokenization and digital assets. So what would you say to the room in terms of first of all, digital assets in themselves? So what are the key things that we need to think about?
Sure. Yeah, thank you. Thank you for having me. Great to be here. And yeah, I don't have any slides, but DOT tends to separate a room in many conferences. So hopefully I can share some of the experiences that I've had in implementing DLT with FMIs. So when we've looked at, from a risk perspective, when we've looked at implementing DLT, there are two kind of sides to this, where you have digital assets, which are existing securities. So you use the technology for bonds or for equities, which we've worked with Euroclear and SDX on. So it's in the traditional side, but using the technology. And then there are digital assets and digital currencies, which are the new emerging asset classes and new cryptocurrencies, which we see fast growing in a lot of markets, which, although they are small today, they are a cause for concern for a lot of the regulators and a lot of the participants that we speak to. So when approaching this, we are very much in the traditional space. So we work with FMIs, central banks, on using the technology. And the area that they're kind of bridging the two together, where if you see in the next 5-10 years, the two asset classes will come together, and that is our anticipation, then any regulator who's looking at the financial stability or investor protection or monetary policy needs to have an idea of how they can deal with cryptocurrency and other asset classes in the future. And I worked at London Stock Exchange for a number of years, and we had a lot of crypto firms or DLT providers coming to us and saying, well, if you had a blank sheet of paper, you wouldn't do settlement like this. But we didn't have a blank sheet of paper. We had a 300-year-old market, and it was infuriating to have people say that we can just start again. So we had to find a way to use the technology in a way that works with traditional securities. And so where you've seen in the UK, we've had, over the last 4 years, we've had 359 applications for crypto licenses, and 9 out of 10 of them have failed AML checks. So we see this as an opportunity for FMIs to provide the role of safeguarding of the security, the stewardship of the markets, but with a new asset class and a new emerging technology. And so for those that are, to answer your question, for those that are going down that path and are looking at the technology for digital assets, there are technology neutral approaches, and Colin mentioned that some regulators there are having different views, and it's not necessarily same regulation, same technology. There are nuances to the technology, but all in all, we've seen similar approaches to regulations where you still have to have frameworks, you still have to have operating models, you still have to have the compliance checks. Everything's similar in that respect, but there are nuances which do have to be called out. And so the three that I was going to share with you were DOT is a new type of operating model. So project planning in a lot of these is paramount, where you now have different incentives for a lot of the business lines. So where we've seen, and ASX is mentioned a lot of the time, ASX wasn't a failure due to the technology. It was introducing a big bang approach to overhaul their existing technology with a poor governance to the actual project and implementation. If you have different business lines with incentives for how they monetize their business, DOT does change some of those. So harmonizing that across a business is very difficult. And that's one of the main difficulties with adoption. If you have a cash cow or a working business model, to then have a innovation team or a new technology come in and say, okay, we're going to try something different because we see the future this way, that is very difficult for a lot of teams to align on. Similarly, on the governance, there are some nuances where you have to have legal and regulatory certainty with things like smart contracts. So can you enforce a smart contract in a court of law in your country? And if you can't reach into a wallet, if there is someone who defaults and you can claim the funds in that wallet, then what happens in the case of a live trading platform? So there are some nuances that we're seeing. And then if you choose public technology, so we are very much private technology, and similar to the Turkey project, if you have permissioned platforms where KYC and AML are integrated to that, then you are covered from a KYC AML perspective. But going into public is a whole new kind of world where you don't know who's necessarily the other side of the transaction, where the transaction fees are, provide gas fees. You don't know who those gas fees are going to. So there are kind of minefield of risks in the public DOT space. So that's why we've opted to have a permissioned private ledger, and we work with FMIs on complying with their existing regulations. And the third area that is slightly nuanced to the technology is the shift in risk. So similarly, we attend a lot of these conferences, and there's a discussion around clearinghouses transforming risk rather than mitigating it, transforming it from credit risk to liquidity risk. Similarly, in the DLT space, if you have a number of manual processes where the risk is in the human error processing those steps, if you now have a smart contract, that has to be auditable, the code has to be available to the regulator who can tamper with that code. So there are some new risks that evolve, and we see the shift of risk rather than it mitigates and eradicates all risk. It just shifts it to another thing, which, if you don't have the capabilities and expertise, that's a difficult step for a lot of FMIs.
Yeah, so, I mean, clearly any new technology like this, there are new risks that are going to be evolving, and there's kind of new ways of thinking that people are going to have to adopt to be able to manage these. I did promise that we would try and keep to time, and I did promise that if anybody did have any questions in the audience, we would allow them. So we might have time for one question if anybody does have a question. Mr. Dr. Abdullah?
Thank you, Jim, and thank you, the panelists. I think they touched upon on very important topics that are very close to my heart as well. And I also want to emphasize of what you say, Jim. I know you more than 20 years, and you've been always insisting on mitigating the risk, and this is something very important. We might have not looked at it, seriously at that time, but I think this is the right time to be very cautious on cybersecurity. And I agree with the gentleman that he said that they don't sleep with the cyber attacks. And we woke up today morning and have seen there was a cyber attack on most sophisticated data owned by the governments. And that means that those guys will always have a path or a way to attack. But do you think that this kind of attack could be eliminated in the nearest future? And although you've seen, as I told you, is the most sophisticated data owned by the government, and I still can see that it can be attackable. So do you think that in the future, nearest future, or maybe midterm, that elimination of cyber attack?
Question. The cybersecurity industry as an industry is very, very fragmented industry. And what happened in the past decade was that there was a big infrastructure shift in terms of cloudification, and also now the AI is a real threat. So what the governments are doing is to try to isolate the data in specific clouds, because the cloud is necessary if we are going to go forwards. Sharing the resources is very critical because AI requires a lot of processing power in terms of GPUs, and also requires big data centers and much more capacity and capex investments to those data centers. If you don't share them, you will lose the advantages of the AI. However, if you then there is a dilemma there. The more if you go to a public cloud, it's less secure. So what the governments and the regulators are doing is to enforce sovereign clouds, cloud for finance, cloud for energy, cloud for healthcare, and so on. And within those clouds, it is easier to establish security, because the more capacity means the more resilience you have. For example, one type of attack, we always think about penetration and crypto, locking the data or things like that. But one very simple method to attack is to provide denial of service. Yes, you can maintain the integrity of the data, but nobody can reach it in denial of service attacks. And it's getting more and more easier to launch denial of service attacks in the cybersecurity world. And the cloud is the way to mitigate that, because the larger capacities means easier to increase your capacities and defend against, collectively defend against such attacks. So, so the way to go, I believe, is to, in terms of infrastructure, is to divide the cloud, divide the infrastructures into sovereign clouds. However, collect the sectors into those clouds, in particular in finance industry.
Time now, if we could wrap it up, that would be great.
Thank you.
Thank you.
So thank you very much to the panel. I hope we've found it useful in this discussion. Certainly things are getting more complex in terms of risks, and that requires a more complex sort of data-driven, interconnected philosophy to approaching risk. So we'd like to end it there, and thank you, and let you go for coffee. Thank you very much.